Hey friends, welcome back to the channel. I'm Iggy, your go-to guide for all things finance, investing, and CPF. If you're new here, let me introduce myself. I've been breaking down complex financial topics into bite-sized nuggets for Singaporeans and beyond. The Investing Iguana was ranked 8th in the 2024 Influential Tigers by Tiger Brokers with over 768,000 reads and 53,000 likes. We've produced more than 700 videos with over 300,000 watch hours as of December 2024. Whether it's stocks, the regional economy, or global trends, this is the place to grow your wealth and financial knowledge. Today's topic is a hot one. OCBC bank stock at $17. Should you buy it? OCBC has been making waves with its strong dividend yield and regional growth strategy, but like any investment, there are risks to consider. So let's break it all down. What's working for OCBC, what's not, and whether it deserves a spot in your portfolio. Let's start with OCBC's growth story, because this is where things get exciting. OCBC isn't just another bank that collects deposits and gives out loans. It's been aggressively expanding into Southeast Asia, where economies are growing faster than Singapore's. Think about countries like Indonesia and Vietnam. These are places where more people are entering the middle class every year. To tap into this growth, OCBC made some bold moves. For example, they acquired Bank Commonwealth in Indonesia and VP Bank Securities in Vietnam. These acquisitions give them access to millions of new customers in fast-growing markets. But it doesn't stop there. OCBC has also been investing heavily in digital transformation. You've probably heard of their One Advisor app. It's like having a personal financial planner in your pocket. Over 1.3 million users are already on board, using it to plan their finances and manage investments. This shows that OCBC isn't just relying on its 90-year history. It's adapting to how people bank today. Imagine this. You're planning to buy a BTO flat or invest in your first ETF. One advisor can guide you step by step without needing to visit a branch. That's convenience people are willing to pay for. Now let's move on to something Singaporeans love, dividends. At $17 per share, OCBC offers a dividend yield of 5.4%. To put that into perspective, DBS is at 4.8% and UOB is at 4.3%. If you invested $10,000 in OCBC today, you get about $540 a year in dividends. That's $45 a month. Compare that to putting $10,000 in your CPF ordinary account at 2.5% interest. You'd only earn $250 annually. Of course, CPF is risk-free because it's backed by the government, while stocks come with risks. But for those who want higher returns and can stomach some volatility, OCBC looks attractive. Here's another reason why their dividends seem reliable. OCBC has a strong capital buffer. Banks are required by MAS, Monetary Authority of Singapore, to maintain a CET1 capital ratio of at least 13% during economic downturns to ensure they can weather financial storms while still paying dividends. OCBC is sitting comfortably at 15.6%, which means they're well prepared even if things go south in the economy. But before we get too excited about dividends and growth potential, let's talk about risks, because no investment is perfect. One major concern is OCBC's exposure to regional markets outside Singapore. Did you know that about 35% of their loans come from countries like Indonesia and China? While these markets offer growth opportunities, they also come with higher risks. For example, Indonesia has a non-performing loan NPL ratio of 5.4%. That means for every $100 loaned out by banks there, $5 isn't being paid back on time, or at all. If this happens on a large scale, it could hurt OCBC's profits. And then there's China's property market crisis. Remember Evergrande? It sent shockwaves through the global economy when it defaulted on its debts last year. OCBC has about $12.6 billion in loans tied to Greater China commercial properties. If property values continue to drop or more developers default on their loans, this could spell trouble for the bank. To illustrate how these risks can play out for investors like you and me, let me share a real-life example involving one of OCBC's investment products, Premier Life Generation Plan. In 2020, Mr. Tan, A retail investor used this plan to leverage his investments by borrowing $500K against an initial capital of $220K at an interest rate pegged to SORA, Singapore overnight rate average. Back then, rates were low, around 2%. But fast forward to today, SORA has climbed to nearly 5%. Mr. Tan now pays $5,700 in quarterly interest. That's $22,800 annually. Even with OCBC's dividends offsetting some costs, his net returns turned negative because rising rates ate into his profits. So what does this mean for you? If you're considering buying OCBC stock for its dividends or growth potential, remember that interest rate movements and regional risks can significantly impact returns. Now let's compare OCBC with its biggest rival, DBS Bank, to see if it offers better value right now. DBS shares surged an impressive 44% last year compared to OCBC's still respectable 34% gain. But here's where it gets interesting. DBS trades at a price-to-earnings PE ratio of 15.2x, while OCBC is at just 10.4x. That means for every dollar of earnings generated by these banks, you're paying roughly 31% less if you choose OCBC over DBS. For value investors who care about getting more bang for their buck, this makes OCBC look like the better deal, at least on paper. From a technical analysis perspective, don't worry if you're not familiar, I'll explain. Analysts have identified strong support for OCBC shares at $15 per share. That means if prices fall below $15, they're likely to bounce back up because many investors see this as a bargain level to buy in again. On the flip side, institutional price targets range from 1950 DBS Group to 2080 CGS Siam, suggesting potential upside of up to 22% from current levels if everything goes well. But here are 3 things you need to consider before making any decisions. First, the banking sector grew by an impressive 19% last year due to rising interest rates boosting net interest margins, NIMs. However, such growth isn't sustainable forever as rate hikes eventually slow down or reverse when economies stabilize globally again. Second, digital disruptors like Trust Bank are gaining traction quickly. They've already acquired over 500,000 users within just 18 months since launching. This kind of competition could pressure traditional banks like OCBC to innovate even faster or risk losing market share. Lastly, MAS could impose restrictions on dividend payouts during economic downturns or crises as part of regulatory safeguards. So should you buy OCBC at 17 earnings? If you want exposure to ASEAN growth markets with stable dividends as part of your portfolio strategy and can handle some risks, it might be worth considering. However, always remember, diversification is key. Don't put all your eggs in one basket. Thanks for tuning in today. If you found this video helpful or have questions about other stocks or financial topics you'd like me to cover next time, leave them down below. And don't forget, subscribe for more insights into growing your wealth smartly right here on the Investing Iguana.